Welcome to Alternative Investing. I'm Mark Bunting, along with my co-host David Kaufman, the president of Westcourt Capital. Now, this is the show where we shift our focus away from stocks and bonds to explore investment concepts that help you break away from the pack and potentially capitalize on some big gains. This week, we'll take a look at two different types of private real estate investing, which will prove to be the better long-term investment, speculating on the future value of a condo unit or buying into a fund that generates steady rental revenues. So first off, David, maybe you could run us briefly through the benefits of investing in real estate.
Sure, and it's interesting when I looked at this list and I looked at last week's list about the benefits of investing in traditional fixed income, it's virtually the same list, which makes sense because what you're trying to do here with alternative investing is diversify primarily out of equities. So we have a list here. It starts with capital preservation, and historically, real estate values are an excellent store of values, so that it's a relatively safe place to put one's money over the long term. And then we look at yield, of course, which is the raw yield plus the levered return, which means that you could make 6 or 7% income on something, and if you lever it up, it can be significantly increased. Appreciation, again, most people understand the notion that historically a good real estate appreciates over time. It may not appreciate in the very short term, but over the long term, we certainly see those effects. And finally, of course, diversification, which I alluded to off the top, where you have relatively low correlation to the equity markets, and most importantly, it's an excellent inflation hedge because real estate tends to appreciate more or less in lockstep with inflation.
Okay, so we're talking about do-it-yourself real estate investing versus investing in a fund. Let's run through the pros and cons. You want to start with do-it-yourself pros?
Sure. So do-it-yourself, first of all, there's no management fees. That's sort of what do-it-yourself implies. And then we have self-controlled, which means that you get to choose what you buy and what you don't buy, so that if you have a certain amount of skill in that area, you can add a lot of value, and a customizable portfolio. That's another important factor because, again, you get to choose exactly where you buy and what you buy, and you can make your own projections as to how that's going to turn out.
What are the drawbacks to doing it yourself?
I have a list here as well. The first is that being a landlord is not always a passive activity. Ask anyone that's ever been a tenant, and they'll tell you that they have to call the landlord from time to time, not so infrequently. Illiquidity is an obvious problem because you can't just buy and sell condos and other types of real estate overnight. Lack of diversification. It's virtually impossible to buy a very diversified portfolio of private real estate unless you're extremely wealthy, which is not really what we're discussing today. Personal financial liability, it's unlimited, so that unlike investing into a pool, you could be on the hook for massive losses in certain cases. And finally, high transaction costs on the way in and on the way out. We'll talk about that later. It isn't cheap.
On the other side of the ledger, you've got real estate investment trusts. So what are the advantages to investing in those?
A lot of these are mirror images. So on the pros of REITs, we have professional management, some liquidity. It's not perfect, but it's better than no liquidity. Diversification, of course, because you're invested in a pool of assets, and limited liability because the most you can lose is what you've invested. And then, of course, on the con side, again, it's a mirror image to the DIY. You do have to pay management fees. You have relatively little control over what the manager of a REIT would buy or sell. It's not customizable for the same reason because the manager makes the decisions rather than you. And the final one was that there's little chance in a REIT or something similar of oversized returns because they're designed to be income generators where all of the extra money every year or every month is paid out to the investors, which means you don't see the same kind of jacked up returns that you might see on the private side.
All right, David, as always, you've laid the groundwork nicely. We're going to take a short break here, and after that, we'll take a closer look at both types of investments to find out where your money will earn the most. Welcome back to Alternative Investing. I'm here, as always, with my co-host, David Kaufman, the president of Westcourt Capital. Now, this week, the topic is do-it-yourself real estate investing versus investing in a real estate fund. And joining us now is Greg Romundt. He's president of a CENTURION apartment REIT, and Hunter Milborne, president of Milborne Real Estate. Welcome, gentlemen.
Thanks,
nice to see you. Let's start with you, Hunter. What's your experience investing in real estate?
Well, I think that a lot of people in Toronto like the idea of investing in a pre-sale condominium because it has a number of benefits. Historically, there's been great appreciation. There's been a good amount of leverage, and it's been a very popular method of wealth accumulation, just the ownership of real estate.
And Greg, what's your background in real estate?
Basically, I've been managing capital for about 20 years. 15% or 15 years would be investment in property and management of those properties. And the last 8 years, I founded Centurion, and we currently operate Centurion Apartment REIT, which is a fund, managed fund for apartment investing.
And I just want to ask you, Hunter, before we continue, you use the term pre-sales. Let's just identify that for everybody. So those are sales where I go and I buy a condo today that won't be ready for 2 or 3 or possibly 4 years in the future. That's right?
Correct. I mean, the large volume of Toronto new condominium project sales today are pre-sales just because of our nice conservative banking community. They like to see 70–75% of the building pre-sold before they'll grant even the most well-heeled developers construction financing. Okay,
so that's a perfect segue into my question about what the model is. So we have all these pre-sales. A lot of them are to investors and not necessarily to end users. So can each of you describe a little bit about if you are speaking to a potential investor, how do you sell the model? What can they expect? And how do you articulate what the experience will be like on the way in?
Well, I think that, if you take sort of an example of, let's say, a $400,000 condominium, an individual, and again, whether it's a user or investor, because part of the reason of buying that far in advance would be some appreciation in value. So if historically the Toronto real estate market's appreciated at about a 4 to 5% annual rate, typically not always even, but let's say you're paying about a 15 to 20% deposit over 12 to 18 months on that $400,000 condominium, so between 60 and 80,000. And then typically that delivery date is about 3.5 to 4 years out. So if you've got that average annual rate of appreciation on the total asset, then you've got a pretty decent rate of appreciation on your deposit.
Okay, Greg?
Well, we operate a managed fund, so the whole point of our business is to provide a hassle-free, conservative way for investors to invest in apartment real estate. And our fund is very cash flow oriented. We see, and that's partly because what we see as the core reasons for investing in real estate in the first place are twofold. The first is protection against erosion of the value of your assets by inflation, so it's an inflation hedge, and cash flow. So our model is predominantly on delivering an inflation plus type return, which is, we distribute an 8% return and target an extra 2 to 5% return of long-term capital growth. So by all means, not trying to knock it out of the park, but deliver consistency.
But Hunter just alluded to the fact that we've had 4 to 5% appreciation in recent times, but you're not promising all of that income plus 4 or 5% appreciation per year. Are you in a REIT context?
No. First off, real estate has a very long track record of returning the rate of inflation. And if we look at any kind of index going back a very long period of time, you'll see that the price appreciation of real estate is virtually indifferent from the rate of inflation. So to anticipate, you might have periods of overperformance over 10, 20, maybe even 30 years, but then you can get the same periods of underperformance for just as long. But if you go over very long periods of time, all you really should expect in terms of capital appreciation is going to be inflation.
All right, Greg and Hunter, let's explore how much sophistication investors need when they're buying and after they're buying for your model, first off.
Well, I guess our model is, an individual investor would purchase an individual condominium. So they're typically buying something that they're going to take title to, that they're going to rent out, or that they're going to resell at some point in either right around the delivery date or shortly thereafter. But I think alluding to what Greg said earlier in terms of asset classes, I think that notwithstanding the fact we're all talking about investments here today, that historical average annual rate of appreciation is based on residential homes. Like that's sort of which might be a little bit greater because it's more of an emotionally driven investment than say apartment buildings or any other type of commercial real estate.
Right.
So, but I think that, on the pros and cons side, obviously I think the Centurion model is a safer model. It's more stable. It's predictable cash flow. Whereas this model, it's a little bit more volatile. Perhaps it's probably more geared to appreciation than income.
So let's just touch on that a little more. So if I don't know what percentage it is, but a large percentage of the pre-sales are to investors, which you mentioned earlier, to whom are those people selling 3 or 4 years later? Other investors? So is this sort of what economists would call the greater fool theory, or are they then selling to people that don't want to wait the 4 years, that are willing to pay full price at that time?
No, they're pretty much universally selling to users, David, because one of the things we track on our buildings that we sell is not only who's closing, but at what point in time is someone actually booking an elevator and moving in, right? So it's nice to know that those buildings are filling up. So almost universally, those resales that the investors bought 2, 3, 4 years before are being sold to an individual user, single guy, single gal, young couple, someone downsizing, a user group.
So, Greg, the question was about sophistication. I'm going to presume that the level of sophistication required by an investor when you're the professional manager has got to be a lot lower.
It is a lot lower. That being said, we have the full spectrum of skill of investors from low to high, but essentially what somebody is getting when they're buying into a REIT is the professional management.
Let's shift into interest rates and inflation. In your model, Greg, let's start with interest rates. How do interest rates affect your business and investors' returns?
In the short to medium term, very little. Because most REITs would exercise a laddering strategy, so not all their debt matures at the same time. They might have 5 or 10-year maturity ladders and sometimes even longer. So a short-term move in interest rates will have limited impact. Again, inflation, the impact on real estate in real terms is very limited. You would expect that your real estate should be appreciating at the rate of inflation. So if it's 5% over the long run, that's what you should expect your real estate to be appreciating, but you're not gaining anything, leverage aside, above the rate of inflation.
And before Hunter addresses this, I just want to talk a little bit more about the interest rates, because I think we assume a lot of the time that interest rates and inflation are always in lockstep, which we know is not exactly the case. So you ladder the debt, and that you have to hope that when the refinancing of the terminating debt comes into play, that at least you'll be able to cover the increase, if there is an increase in those rates, with increased rents. But we do have a lot of rent control, certainly in Ontario and certain other parts of Canada. Is that a problem? Not
really. I mean, you have to remember, I'll speak to the Ontario example. It is geared to inflation, which, if your costs are geared to inflation, so it's not really too much of an issue. The other thing is that is a critical aspect of buying real estate, is not to be using so much leverage, so that if you do have a debt maturity and rates are higher or the financing environment is not as friendly, you've got the ability that it's not going to significantly impair your cash flow.
And Hunter, when we spoke earlier, you actually told me something I'd never heard of before, which is that investors in condos can lock in their mortgage rates long in advance. Can you tell us about that? Because that's an important element.
Well, yeah, several of the major Schedule A banks in Canada, I think they look at that mortgage as a bit of a loss leader for them. So if they get a customer that's going to have a mortgage with them for 20 or 25 years, they can cross-sell them insurance or credit cards. So it's almost like a loss leader. So it's quite common now that for up to 36 months, a purchaser can get a commitment today for up to 80% of purchase price on a conventional loan and cap the rate. And then once they get to within 24 months or 18 months, then that rate can actually drop below the posted rates. So it's a very advantageous benefit for a purchaser.
Let's take a short break there, gentlemen. We'll come back after this, and we'll continue the discussion and look at how yield and appreciation in these two types of real estate investments compare.
David Kaufman is one of Canada's leading experts on alternative investing. He is the president of Westcourt Capital, a registered exempt market dealer.
Welcome back to Alternative Investing. I'm here with David Kaufman, president of Westcourt Capital, and our guests, Mr. Greg Romundt, president of Centurion Apartment REIT, and Hunter Milborne, president of Milborne Real Estate. So let's discuss, shall we, fluctuations in the real estate market. And I'm thinking of possible bubbles. You think about Vancouver, maybe Toronto, and how that affects investing.
Well, I think that's always an issue. I mean, we've been marketing and selling Canadian condominium properties for about 35 years, and there was a cycle in '82, there was a cycle in '89, '90. So I mean, the historical average annual rate of appreciation is that it's an average. So what happens? Sometimes it gets ahead of itself. Sometimes it has to catch up. So we've always advised our clients, just if you follow two simple rules, don't buy more than you can afford and don't sell at the wrong time, then you're going to avoid those peaks and valleys.
Greg, what do you think about fluctuations in the market?
Well, I mean, I would first say that there is no real estate market. I mean, all real estate is local, so to say that we're in a Canadian bubble is one thing, and it's another to say we have bubbles in certain specific areas. Additionally, it's another thing to compare condominium prices and house prices to, let's say, the values of office towers. So they're just not comparable. That being said, I do think that in certain areas of this country we have very dramatic bubbles. And if we take a look specifically at Vancouver is now trading at 11.2 times average earnings, and Toronto's trading at 6.7 times average earnings. Both of those are trading at around double their long-term averages, and and affordability is generally considered at about 3. So Toronto's 2.5 times affordable, and Vancouver is 3.5 times the rate of affordability. So I certainly have significant concerns about overvaluation in certainly these markets.
And to that point, one of the things that we've learned on this show about volatility is that you can go up 5, 5, 5, 5, 5, and then if you go down 20, you're a lot worse off than you started. And so, Hunter, we asked before the break the question about who you're going to sell to later on. And so if everything continues the way it is, you're going to sell to those end users that don't want to wait the 3 years and want the keys and move in the next day. But if there is a correction, let's forget about a total crash, but a simple correction, do you fear for your investors that the quality and the quantity of the buyers in that field will dry up, and that there would be that would lead to a bit of a spiral down?
Well, it's possible, but I think that the timing could be affected, because I think the investors today are not the speculators of yesteryear. They're basically putting up a significant deposit, so they're going to close, they're going to rent it out, they're going to resell it. So if option 1 doesn't work, then option 2 could. So if there happened to be in a period of where it's a bit slower and there is a correction, then the plan B is to rent and hold for a different time.
And Greg, you say real estate is local. That's a well-known phrase. How does it impact your company as far as when you do have variations across the spectrum, as far as a bubble here maybe and some weakness elsewhere?
Well, I think there's a big difference in how multi-res or any commercial class of real estate is valued relative to condos or apartments. Commercial classes are valued as a multiple of income, much like a price-earnings multiple. Whereas in condominiums and houses, they're valued on comparables, house, whatever somebody else is willing to pay. So we don't see those kind of similar bubble-ish characteristics, because we're much more constrained by banks' debt service ratios and the leverageability of the asset than our individual condo levels. Certainly when we're making our buying decisions, we're looking for very long-term holds. So we're not looking to flip in 2 or 3 years. So we really have to be considering, are the prices that we're paying now going to make us money for 10, 20, or 30 years? And if we can't, then the decision becomes, do I retrench, do I do nothing?
And whatever metric you end up using to determine the valuation, say, of a portfolio of apartments, if you look around the real estate space generally, you'll see that institutions, of course, have got more than just a toehold in some of the high cash flowing assets that are across this country. But I don't really see that in the condo world. Is that something, Hunter, that you know of? Is there a reason that institutions don't get involved in the pre-buying condos and riding the same wave that your investors are?
Because I think it's just a different asset class. I mean, I agree with Greg in that, because it's it's not income driven. It's more of a residence, so it's more emotionally driven. And I guess because of that, it could be a little bit more volatile. But I think some of the macro fundamentals that we talk about. I mean, since the province implemented their Greenbelt in 2005. That took away a big supply of low-rise land. And I never envisioned that the supply of single-family or townhouses in Woodbridge or Maple would affect what we're doing in the downtown condo market. But, in 2007 was a banner year in terms of volume. And what's happened, Toronto for the last 10 or 15 years has always needed about 40,000 new housing units a year to stay even. And it's not quite getting that right now. So there's a lot of people moving to the city, 100, 125,000 people per year, and they have to be housed. So,
Greg, could you talk about liquidity and how that impacts investors?
Well, I have to say the first thing that people have to think about when they're investing in real estate, no matter what sector that they're going to play in, liquidity is a secondary concern, because it's very, very high transaction cost business. Land transfer costs, legals, financing, and brokerage fees. Like, no one works for free on the way out. So it's very important that you go into the asset class with a long-term view. That being said, for us in a managed fund product, we do provide liquidity, which is on a 30-day basis for redemptions. So we do provide that liquidity, but people have to know it's not an asset with tremendous liquidity.
Yeah, and you need to look no further than California, Nevada, Arizona, and Florida to know what happens when there is no liquidity. Because, of course, when you have the staring contest between buyers and sellers, when fear is the major motivating factor, someone's going to blink first, and usually it's the sellers. And one seller blinks, and so the prices go down, so someone else has to do the same thing. And so, Hunter, what is it about Canada generally, or Toronto or Vancouver specifically, that is going to protect us from having the same kind of events transpire here?
Well, I think that's a very good question. I think, one of the things that a lot of people don't realize or forget something is, Canada has the second largest oil reserves in the world after Saudi Arabia. It has a poster child of the world banking system. I think that it's very regionalized. I mean, what happens in Montreal and Vancouver are quite different than what happens in Toronto. So Toronto's particularly blessed with all of those Canadian factors, but also a significant net in-migration of people every year that has been a factor and will continue to be. So I think that it doesn't guarantee that you're going to have that annual appreciation, but it's a supply issue. It's really just if there's more supply, that may not be the same, but if there's less supply, it's going to appreciate faster.
All right, gentlemen, we want to see if we can resolve this debate. We've been talking about do-it-yourself investing on the one side in real estate and REITs on the other. Take us out, say, 10 to 15 years, capital appreciation plus yield. What are investors looking at, do you think, in your model?
Well, it's hard. I mean, there's no crystal ball, but if you took the last 10 or 15 years, I think that people could expect probably a 10 to 12 to 14% IRR, internal rate of return, on their mix of cash returns on rents and appreciation.
And Greg?
I go back to my earlier view that real estate on a capital basis will provide you about 2%, and your strategy on an unleveraged basis should give you another 4 to 7 in cash flow. But I would have to disagree that there's condominiums or houses are a 12 to 14% rate of return business on an unlevered basis. It's virtually impossible. I mean, you go to the straight mathematics of the situation. Who buys houses? Average people. And what do average people's salaries go up at? Inflation. So they have to be affordable. And aside from artificially low interest rates for short-term periods of time, if people can't afford these properties, prices are overdone.
All right, gentlemen, thanks for coming in. Thanks for your insight today. Good to see you, David, and we'll see you next time. That's all the time we have for today's show. If you've got a question about alternative investments, email us at alternativeinvesting@bellmedia.ca. Thanks a lot for watching. We'll see you next week.